Think about or talk a little bit more about context and make a little bit of a video on an area that I think it's really easy to lose a lot of money. And this is an area where I think a lot of traders would lose a lot of money. And the reason is, context. You have to think more about context within trading ranges. And stuff like this is what makes trading hard, I think, at least in general. So to start out, just kind of looking at the prior day's context, where is the day opening, right? The day is opening in towards the middle of yesterday's range. Why is this area support? Oh, I'm sorry. Why is this area support? Well, the bears who sold 34, 35, 36, selling for any reason, know that they're probably going to get a retest of this price at some point. The traders taking this trade are going to have an extremely wide stop and be willing to scale in. And so if you're a bear, just think about it logically. If you're a bear and you sold this close, how do you feel about this rally? You're probably, not happy with it. You're pretty upset that you got trapped in the trade. If you're an algorithm, you'd be scaling in higher, trying to get back to this price or help the market get back to this price, and then exit your shorts when you get back down to here. So if you're looking at this day, let's say the market's opened and you're in a trading range and you see bar 7, 8, and 9, and you think to yourself, oh my God, I got to sell. We have 3 big bars. We're going to get a second leg down. And then you sell and you see this and you're confused. It's not necessarily, you don't need, I'm going to phrase this the wrong way. Let me think about it for a second. You shouldn't be surprised when you get that sort of pullback in this sort of area because the bears are buying back shorts. And if you're selling the close of 9 and your expectation is you're going to get a second leg down, you did get a second leg down. It just looked like 12, 13, and 14, which is not really ideal for a second leg down. So spend more time calibrating your expectations to what it means to you when you say, I think this is going to get a second leg. The context reflects what the second leg should look like. So, yes, the sell off to 9 is going to get a second leg. What does that mean? It means we'll probably get back below the bar 9 low at some point. That's really it. It doesn't mean that we can't get a really deep pullback and then get a second leg down. And so, this should get a second leg. And, you could argue that it didn't really get a second leg, but we ended up getting back down to that price. And so use context to calibrate your expectations for a second leg, because it's not enough to sell the close of 9, expect to get a second leg, and then get stopped out and be confused as to why you lost the trade. It's not enough to buy the close of 11 expecting a second leg and then get stopped out. If you're buying this close, you have to realize that 7, 8, and 9 is going to get a second leg, and 10 and 11 also should get a second leg. So if the bears should get a second leg and the bulls should get a second leg, then what does that mean? It means probably big up, big down, and confusion, trading range. So you have to be expecting more of trading range price action. So anytime you get big up, how should I say this? Think more about the context of the market are we in a big up, big down, big confusion area, trading range price action, or is this a breakout? Is it going to, go further, right? So when you see this and you're expecting a second leg down, and you see this and you're expecting a second leg up, that should immediately be your, you should get a signal in your head saying, hey, stop buying high and stop selling low. It's not trending behavior. This is buy low, sell high behavior. Whereas, in trading ranges, you can tell it's better to buy the low and then go for a move back up. You're betting on the second leg, but you have to think about the way you're betting on the second leg differently. I know I'm kind of, I don't have a lot of notes on this video. I'm kind of just making it. So I'm sorry if it's a little bit choppy, but in essence, you have to think about, like I said, your expectations for the second leg. So you can't buy this close expecting us to go somewhere up here. If you buy this close, you have to be willing to scale in lower and then expect the second leg up. If you're selling this close, you have to be willing to scale in higher. You can't just sell the close and hope we go lower. And even over here, why don't you sell these closes? Because look at 15 through 25. This is more of what I'm talking about with context. Yes, if you just isolate 25, 26, 26, 27, and 28, and you don't think about anything else, a lot of times those are pretty good sell the close bars. But in this context, you're selling against 15 through 25. And why is 15 through 25 important? Because it's a tight channel up. I would spend a lot of time thinking about tight channels and looking at them and making slides on them, because they are important, because they're breakouts on higher time frames. So you can see 16, 17, 18, or these 3 bars on a higher time frame, are a breakout. So would you ever want to sell 25 against these 3 big bull bars or these 3 bull bars? Probably not. So you should think more Okay, sorry, I was just checking that. You should think more about this tight channel and what it means on a higher time frame. So I would spend a lot of time, I guess I would say the point of this video is to think more about the way that you study, because there's no bad way to study. I think, I've studied in a gazillion different ways, and some of them were less effective than others, I think, but I don't really regret any way that I've ever studied before. But my point being, spend a lot of time thinking about tight channels, because tight channels are breakouts on higher time frames. So make slides on tight channels, compare time frames, compare the 5-minute with the 15-minute. Go through this day, this 6/13/24. Look at what this looks like on a higher time frame. It's probably a breakout, right? And think about second legs in trading ranges versus second legs in trends. So calibrating your expectation for a trading range instead of buying this close, buying low, and calibrating your expectation for a trend where you can buy. I'm just going to scroll back and find a trend, but where you can buy closes, buy closes, buy closes, buy closes, even sit through a deep pullback and still expect the market to go higher. Buy closes, buy closes, buy closes. We've been always in long the whole time. Versus over here, are we always in long? Are we always in short? I don't know. I mean, maybe we're always in short. Maybe we're one bar away from always in long, one bar away from clearly always in short. So that's the thing to think about. And why don't you sell these closes 14? Because you're selling the bottom, right? That you think about it from a bullish perspective with 10 and 11. Although 12, 13, and 14 is strong, if you're a bull who bought, you still have sort of protection from 10 and 11 in a way, in that the bears will probably not get a successful breakout below this low because these two bull bars are so big. Go find a bear trend that starts with this sort of sell-off and then gets these types of bars and then turns into a bear trend. It's really hard to do. There aren't very many of them because the probability is there will be buyers below here. So really just a video on second legs and expectations for them is what I was going for here. But anyways, that's it.